Well, thank you everybody for being here today. I am really delighted that we could all actually be in person and get back here after 2 years, as sure everybody else is in the room. And it's great to be back at the ball field. Different name this year, but it's a great venue, and we have a great lineup of speakers and panelists today. Again, this will be Zoomed, and we hope to record it and have it available too. So if you missed some questions, we'll have it up on the website at some point. So we're going to get started. We're good here? Thank you. So on behalf of the Gabelli organization, my name is Max Sykes. I've been covering Berkshire Hathaway for the company for over 15 years now. We've been coming out. This is our 16th annual trip out here. We've been running a conference in coordination with the annual meeting tomorrow. And then Mario, the firm, sponsors a dinner with CBS tonight. So we're really delighted to have you all here today and have all the speakers. We're going to run through the meetings pretty quickly. There'll be some Q&A during each session. So we encourage you to ask questions. And then we're going to take a quick break, and then we'll convene for the Value Investor segment of the program. So without any further introductions, I'm going to get into our first group. So today, I'm delighted to have Adam Mead. Adam is the noted author of this book, which will be available over at the conference center later today. So he spent, I think, 5 years putting this together. It's an amazing group of research about the conglomerate going all the way back to 1965. And he also runs an investment firm in New Hampshire. And then to my left is Chris Bloomstrand, who is also a coordinator on the book. He runs an investment manager in St. Louis, has often written about Berkshire Hathaway, and has written the foreword in this book. Is also a guest lecturer at many schools. So today we're going to be interviewing these gentlemen about the book, their adventure there, and then we're going to be talking about the conglomerate. So welcome. Maybe we could just get started, gentlemen. Just talk about Adam. Why don't you start off about how you got started on this book, why you did it, how much help you did, and maybe your coordination with Chris as well.
Sure. First, I got to say hello to Abigail and Julia, my two daughters. I said I'd say hello to them. So, I have absorbed everything on Berkshire, like probably many of you in the audience, and maybe 2014, 2015, I'd always sort of pined for something a little bit more, kind of geek out on the financials. I'd read Warren's annual letter, and he'd say, okay, the MSR business has earned, 18% on tangible capital, and I'd go into the 10K and try to dig that out. And I thought there was a place I just always pined for this book that just went chronological, year by year, just really pulling out all that nuance, that detail from the 10K, incorporating all the lessons from his letters. And so just one thing led to another, and I just started writing it. And I started in 1965 and sent the first chapter to Warren, and to my delight, he wrote back and said, why don't you go back to the pre-World War II era and see the temporary profitability that the conglomerate, or the textile mill at that time, had enjoyed. And so, of course, Warren's suggesting something, I'm going to do it. And so that led me to go back actually to the beginning of all the Berkshire original subsidiaries, all the way back to the 1800s, and just walk all the way forward. But I feel incredibly fortunate to, use a familiar term, stand on the shoulders of giants, benefited certainly from Chris's annual tomes on Berkshire. Guys like Cunningham and Kilpatrick and Lowenstein and Robert Hagstrom. All those guys influenced my understanding of Berkshire, and so all of that goes into the book. And Chris was gracious enough to write the foreword for me, and here we are.
Maybe you could just talk a little bit about that interaction. I believe you just met in person here for the first time. Is that correct? So all this work that you did to do on the book, you did basically virtually. Is that correct? And how did those interactions go, kind of with coordinating research with Chris?
Yeah, and I think we had corresponded. I think, maybe again, 2014. You've done some work on cash taxes on Berkshire, and I emailed Chris, and he got back to me, so that struck up the dialogue. But Chris was gracious enough to offer to read the manuscript, and I can't give him enough credit. He'll defer, but it really helped me find my voice in this book. At first, I think I was quoting Warren too much, and Chris said, just use your own voice, and had some other great suggestions. So thank you, Chris.
I think the book, if you don't have it, is just a phenomenal resource, and for the uninitiated to Berkshire to run through the history of the business sequentially by year and by decade. I found myself this year putting together my letter, reaching for the book multiple times. Little things like the share count in a certain year. If you really want to get into the weeds, it's phenomenal. If you want to learn how Berkshire works, it's likewise phenomenal. So it was fun to be a very, very small part of it. Very small.
So to take a victory lap, Adam, I think Warren also insisted on buying books for all the board of directors of Berkshire. Is that correct?
He did, yep. He wrote me a very nice letter and insisted that he purchase 20 copies for the Berkshire board. And
he took out Goldman's fee.
All right, so we've now established, gentlemen are both experts kind of on the conglomerate, and we're all here for this great weekend. Why don't we just talk a little bit about your expectations for tomorrow's meeting? Could we get some surprises? What kind of feedback are you looking for from the duo and also Greg and the G? So what are your expectations for the meeting and some feedback?
Go first.
I'm just thrilled. We're all back here in Omaha for the first time in what seems like a million years, and to have the 91-year-old and the 98-year-old as cogent as they still are, be with us for the next couple days. It's going to be great to see what Greg has really done over the last couple of years, 3 years. I think he's immersed himself, obviously, in the subsidiaries. I think if you look through to the profitability of his corner of the operation, eliminating the pandemic year, you can see some real operational improvements in that manufacturing service retail group, and I would attribute that to, in all likelihood, his involvement. So I hope we get a little bit of granular detail, but I'm just thrilled as can be to be here for the weekend.
Yeah, I'm excited to be back too, and I'm sure there'll be questions about geopolitical current events and all of that, and I would expect to hear the familiar lines of invest for the long term, and we've had wars before, and use it as opportunity. In terms of surprises, I'm not sure. So Charlie just stepped down from the Daily Journal board, and we were just chatting a minute ago, and as chair, he's still on the board. Maybe this is the year that Warren hands the CEO title to Greg officially, and remains chairman. But other than that, I really can't expect any surprises. It's really every year you come out here and you learn something new, but it's usually the same kind of flavor. But it's really great to be back.
I think it'd be fun to hear. I hope we hear quite a bit about how they're dealing with the current inflation, which impacts in part so many parts of the business. Again, that MSR group, a lot of those businesses are fairly low margin. You think about the dominant position the railroad has and the utility operations have, and the ability to pass through price escalators there. That doesn't exist largely in some of that group. So as broadly diversified as the operation is, I think we'll get some color both in the release and certainly during the commentary.
Yeah, I hope to hear a little bit more about maybe the subsidiary governance. If I can ask Warren a question tomorrow, if I'm lucky enough to get a microphone spot, he's sort of teased over the years that Tony Nicely stepped down as CEO, but he's chair of Geico, for example, or Mary Reinhardt, I think at Johns Manville, is now chair of another subsidiary, and so there exists a governance structure below the surface, even though Warren likes to say, the managers run the show. I'd love to hear a little bit more color on how that subsidiary governance maybe works from a day-to-day or month-to-month.
Okay. So it's been, after a few years, it's been a pretty active set of months of capital allocation for the conglomerate. And I think, they had already purchased the preferred in Occidental, and I actually heard a story about how Vicki Hollum, who's the CEO of Occidental, came in to Warren. And it turns out that her first job out of school was to work at a firm called City Services, and that was acquired by Occidental in 1982. So she had an affiliation there. And if you go back a couple years to Warren's letter, I think it was 2019 or 18, he talks about when he was age 11, one of his first major investments was an investment in City Services preferred. So when Vicki and Warren met, I assume to talk about the financing for the Anadarko purchase, they had that connection, which seems to show up in a lot of familiarity. So Warren tends to invest with people that he has a connection with and he trusts. So maybe, as we look into just the capital allocation, Chris and Adam, maybe you could just comment on, what have you noticed in terms of the strength of the capital allocation recently? Is there anything to be taken away from Occidental, Allegheny, Hewlett-Packard, some of the other ones, just in general? Does that signal anything as well? So maybe just your thoughts on what we've seen in terms of that activity.
I think, I find the capital allocation in the last few years to be brilliant. There's an acknowledgement that in a world of a lot of money sloshing around in private equity, that the control premiums that you'd have to pay to do big deals would be disadvantageous economically. The share having been as cheap as it's been for the last 3 years, the ability to buy back $27 billion a year at that cadence, which effectively gobbles up all of the cash operating income of the business, has been terrific. Here in the last few months, as the stock has moved up and trading today closer to 1.5 to book, the cadence of that repurchase program has slowed, and so now deploying 11.6 into Allegheny and another $7.5 billion into Oxy. Very different transactions, but very, I think, economically attractive, both for different reasons. Allegheny, if anybody saw the editorial in the Financial Times yesterday suggesting that Buffett break up the business, that it's an underperforming operation, is just lunacy. So many of the subsidiaries that exist inside of Berkshire are better off for being inside of this fortress balance sheet. Allegheny, which we owned, I'd gotten to know Weston Hicks, who just retired as CEO. Over the years, we bought it for the first time in March of 2000 when everything was cheap. Weston hired Joe Brandon, who had been at Gen Re, and there's a story there. In any event, so you've got this Allegheny, which has 3 different insurance operations, Trans Re. They've got a little gem of a wholesale specialty business, an RSUI, and then a little bitty cap specialty, which has been a little bit of a burden for them. But collectively, you've got an operation writing $7 billion in premiums. So Berkshire is going to pay $11.6 billion for a business with a little over $9 billion in equity, but $22 to $23 billion investment portfolio. That, because it's an insurance operation, not Berkshire Hathaway, is going to invest most of its reserves and invested assets in bonds. So Weston had, let's call it a $3.5 billion stock portfolio at year end, and the balance was in fixed income. What Berkshire can do is, first of all, those 3 insurers can retain a lot more business because now you've got Berkshire's balance sheet behind it. They're not going to have to go to the retrocessional market. I think the $2.5 billion or so in net debt that exists at Allegheny will get paid off. Berkshire does not carry debt in the insurance operation, so you've got a couple levers on profit coming in. The Trans Re, in their property lines, they write a lot of proportional business, which has taken 20% price increases in the last 2 years. That's going to start flowing in. But the real 2, I think, kind of hidden gems that you're getting in this business, one, Berkshire can flip the investment portfolio over time from bonds to stocks. And the differential on earning 4% on a bond portfolio over time on $22 billion and earning on a 70 or 80% weighting in common stocks, if they can earn 9-10%, you've got $600 million in additional annual earning power because of the way Berkshire can invest the assets. And then finally, they get Joe Brandon. And I think, we've all asked the question over the years, who's behind Ajit? Who's behind Ajit? Joe's a very, very phenomenal insurance executive. I know a couple, 3 years ago, 2019, National Indemnity did a big deal with TransRe. So Weston and Joe had come out to Omaha and spent time with Mr. Buffett, and I think repaired that relationship that Warren and Joe had. And he's just great. I mean, I've spent time with Joe, not as much as I have with Weston, but it's a very good transaction. And with the increased profitability that comes, Allegheny is a far, far better insurer inside of Berkshire than it is on a standalone basis trading publicly. The other thing that they get is Weston had to build up Allegheny Capital. Compare it to Markel Ventures. Control premiums there are tough. I mean, they allocated $1.3 billion to private businesses, and Weston would tell you it was very difficult to try to get deals on economic terms that made sense. That role disappears. I mean, I think that Allegheny Capital just gets rolled up into Berkshire, and the capital allocation, if they're going to do subsequent deals, gets done out of Omaha and not out of that Allegheny sub. So a lot of moving parts to make a deal like that very attractive.
And it's almost a mini Gen Re, with the moving to the fixed income in a much smaller way. And you've written about that as sort of this great pivot. But I guess more broadly on capital allocation, how lucky were we as shareholders that the stock price, was what it was when deals were not attractive, and to be able to put out that much capital. As Chris said, basically equal to operating earnings for 2 years. And now with some of the uncertainty that's happening in the world, the ability to deploy this capital at advantageous prices, Berkshire famously has no strategic plan. I mean, its plan is no plan. And sometimes these deals just hit all at once, and we go through these periods of dry spells. I think it was the year 2000. Berkshire acquired maybe eight separate businesses in 1 year for maybe about $8 billion. That was the year they bought Shaw Carpet for $2.3 billion. Johns Manville was $1.8 billion. Benjamin Moore for $1 billion. Actually, there was a year they acquired Mid-American Energy, which is now Berkshire Hathaway Energy, for about $1.2 billion. So these things just sort of happen, and I can't really say that there's it's probably just coincidence, but I would say that some of the uncertainty in the markets today is certainly working in Berkshire's favor, and it's always ready when a favorable deal materializes.
I've got a comment, if you want, on Oxy.
Yeah.
If anybody thinks that the chairman and CEO at 91 years old has lost his touch, is an example of why he's still such a great investor. So I think Oxy overpaid for Anadarko. They wound up having to pay a 15% breakup fee to Chevron. Mr. Buffett came in with a $10 billion preferred at 8%, which gave Oxy the option to pay either cash or shares on their dividend. You had the pandemic, you wouldn't have predicted that. Oil traded for a moment on the front end of the first curve before below zero. Profitability was down, so when they started paying those $200 million annual dividends, they were paying them in stock and not in cash. But Oxy was very, very cheap. And unless you had a constructive case on energy, you didn't know if they were going to make it. They had put $40 billion in debt on the balance sheet. We made it through, the oil price recovered, and you were getting dividends in stock in the low teens, high teens, low 20s. Here you are with the stock trading in the high 50s. Oil largely recovered. When Berkshire got those dividends, they sold the stock, even though the stock was cheap. Mr. Buffett changed his mind, and very few investors understand the importance of changing your mind. His thesis on oil changed at a much, much higher price point, and then goes out now and gets $7.5 billion in the common, way above prices at which he could have had shares at a lower price point. Testament to, I think, the great investor that he is and has been and will be for hopefully quite a few years to come.
So why don't we go out to the audience with questions? Does anybody have any questions? Okay.
Do you think it's impossible?
Or why don't we're going to give you the mic, just so our Zoom audience can hear.
Do you think it's impossible that we will ever learn what the subsidiary CEO's compensation is based on? The formula that each of them uses?
Well, I mean, some of I think the CEO's comp at Berkshire Hathaway Energy is public, but I actually asked that question a couple of years ago in a different way, but I think it's, sort of the inside secret. But Buffett has talked about over the years that depending on the type of business, that influences the comp structure. And so if it's a See's candy business that really doesn't require any capital, it might be tied to earnings. If it's a more capital intensive business, there's a capital charge. And so that doesn't answer your question in terms of specifics, but that's sort of the general philosophy inside Berkshire.
I think they've all been uniquely structured. At the time Mr. Buffett would buy a company, they'd work out whatever formula made sense for that particular business or industry. I think he's a master of understanding incentives. I think the struggle would be as some of those CEOs got older and retired or passed away and the mantle was passed. I'm not sure those deals and those structures kept up with how those businesses work. So I presume this is one of the things that Greg Abel's been doing here for the last 3 years, is getting his mind around comp of the management teams and how the subordinates of the CEOs of the various subs are doing. I mean, you can see it in the profitability, so there's something good happening, and I presume that's part of it. But I still think it's going to be, there's no magic bullet, single formula that you would apply. There's so many different types of businesses where you're just naturally going to have different comp structures.
Wait, let me get you the mic here. Okay.
Thank you. Good morning, gentlemen. When Marr, obviously 91, going to be 92 in August, when he eventually does pass, the foundation is going to get a large part of the shares of the stock, a lot of the Berkshire Hathaway stock. And isn't it important who's running the foundation and how they impact Berkshire?
In terms, like say
So
Bill
my point is that the foundation's going to have, he has 40% of Berkshire. The foundation's going to have 40% of Berkshire. He's the major domo. The foundation's going to be able to make some decisions.
Yeah, I mean, I think they've now since 2006 when he started giving away his shares. I don't think anything major is going to change, and the foundations are required to sell off some over time.
They have to give it away, but they're still going to have the voting power until they do give it away.
Yeah, I guess I can't say for certain, but I guess I would not expect anything major or drastic to happen on that front.
Well, you want people that own the share to think like we all do, and that understand the culture of the place is very important. I think the Gates Foundation, with Bill involved, certainly as many years as the two were great friends and sat on the board, I believe they understand the culture.
Well, that's part of my question, is because we both know we all know what happened with the Gateses, and so that's got to affect the foundation in some manner.
It will. My hope is that the shareholder base continues as it is, and that we have a lot of rational people that think about governance differently than CalPERS and various others think about governance. And I'll leave my comment at that.
All right. Thank you.
All right, so we have one more.
Hi, thank you for organizing this. Just a question, after the acquisition of Allegheny, do you think that the unique relationship that Buffett had with Brandon is one of the factors of the acquisition, or is it something that he's looking at the Markells of the world and other smaller baby Berkshires, if you will, which might be better off inside of Berkshire, and kind of having these smaller teams of doing capital allocation at smaller sizes, and then instead of having one or two guys at the helm with these big chunks of capital?
I would say I'm not sure it's more complicated than they had remedied the relationship and had worked together on some deals over the last 3 years. I think to the extent if there was a void in succession in the insurance operation. Joe's fantastic. I mean, he really is a marvelous operator, an insurance guy. I would guess that we're not on a roll-up of insurance. I mean, Berkshire doesn't need that much more insurance premium. Although $7 billion on $70 billion to Berkshire is an increase of 10% in premium. They're buying the business at effectively, when you would adjust for the increased profitability, at a mid to high single-digit multiple to economic earnings. If you add up the Oxy money that was just spent, the Allegheny money, the money that they invested in Hewlett, you add that up. If we're not going to be repurchasing a lot of stock at 150 of book, you effectively, to try to keep the cash balance where it is, you need to spend mid 20 billions. Well, that's kind of what they've now spent here in a short period of time. If you add up those three deals, I'm not reading more into it that we're now on a mission to spend a bunch of money. But when deals come along and you find good people, and the other thing to take away is, I mean, they really did that deal in a very short period of time. But Mr. Buffett would have read Allegheny's annuals, and he knows the people involved, and he knows the integrity of the operation. You can see the underwriting history of TransRe and RSUI in particular. Very good insurers. They've been through hurricanes and pandemics and crises, and you see where they reserve properly and conservatively. And so it just happens to be, I think, the Allegheny culture that Weston had built and that Joe now runs is a perfect fit inside of Berkshire, because they think about capital and people and taking care of all of your constituents, similarly to how Omo thinks about it.
All right, we have about 5 more minutes, and to conclude, I would just like to go through your opinions, a sense of where you think the fair value is. Are we still at a discount above that today? And what do you think? I mean, we've had a nice rise in the shares already this year. Stocks outperforming the market. What are your expectations for returns in the next 5, 10 years as well?
Yeah, I mean, when I look at Berkshire and use various methods to value it and just look at it, the sum of the parts is really the way to go, and you can break Berkshire into a couple of different chunks. It's even if you take a very, very conservative approach going through these lines, you've got 150 billion in cash. Even if you take a big haircut off the investment portfolio, say for Apple's rich valuation, subtract the deferred taxes out of there, you're still looking at a conglomerate, even after 20-25% plus increase in share price, that's still pretty attractively priced. And you're not buying, as Buffett says, you're not buying a picture, you're buying a movie. And so this is a collection of mostly wonderful businesses that is ongoing, and as Chris mentioned, we have Greg in there that's finding ways to tweak some of the MSR businesses and make them better, and it's still all of that on top of really a fortress balance sheet that can take pretty much anything that happens economically. And so I won't give you a specific number, but I think it's still attractively priced, and perhaps round numbers, maybe 10% a year going forward.
I come up with all of the machinations I go through to appraise the business, about $48 billion in current economic earning power. That's a very conservative number if you presume that the stock portfolio only earns the earnings yield. Apple has been a phenomenal performer in the last few years. We took a $36 billion investment, sold a portion of it, but worth $161 billion at year end. If you presume the stock portfolio only earns 5.1, 5.2%, which is the earnings yield, you get to my $48 billion. If the stock portfolio does 10% a year, there's an additional $16 or $17 billion embedded. So a business that conservatively earns 10% on equity, more if the stock portfolio does better than 5.2, 5.3% a year over the next 10, 15 years, you're paying 150% a book for a 10 plus ROE. It's still very undervalued, especially relative to the market. Absolutely it's undervalued, and relatively it's undervalued. The ongoing repurchases, even if they slow a bit, are a reflection of it's a terrific use of capital. Stock hasn't been overvalued for a long, long time, and as an investor that has cash always on hand and dividends, we all have money to invest, we're net savers. You'd rather have a low stock price than a high stock price. And we should all stop talking about it in favorable terms.
Well, great. That concludes our session. Thank you. And on behalf of the Gabelli organization, I appreciate you coming here today. And I'm going to turn it over to my colleague, Brett Kearney, who's going to bring on the next panelist.
Thanks, Mac. Thank you, Mario.
Investors should carefully consider the investment objectives, risk, charges, and expenses of the fund before investing. The prospectus, which contains more complete information about this and other matters, should be read carefully before investing. To obtain a prospectus, please call 1-800-GABELLI or visit www.gabelli.com.